Macroeconomic expert Raoul Pal just changed his mind on Ethereum. He's now more bullish on Ethereum heading into the final stages of 2025 and into 2026. If you've been in crypto for a while, you know the history. In 2020 and 2021, Raoul famously switched hard from Bitcoin into Ethereum. Later, he leaned into faster chains like Solana and Sui. But in his latest interview, he comes back to a core idea. The financial system is going to build on Ethereum, not exclusively, but enough to matter for price, flows, and structure of the next cycle. Let's hear Raoul in full and then break it down. And before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Now, let's dive in.
What is Ethereum? Ethereum is basically a gigantic scale network that records contracts. Oh, so it can apply to everything. Yes. And what drives a lot of the adoption of any of these things? Memetics. So think of it as a memetic contract new world, which is a replication of what we built as humans. It's all the printing press was, all of this stuff. In fact, it's all AI is. It's all the same thing.
Does Solana do contracts?
Yes.
But
so,
Ethereum's the first.
I'll come on to that.
Right.
So Ethereum was the first. Great. It's the OG. It's slower. It's a bit complicated, blah, blah, blah. So there's other fast ones. There's Sui and there's Solana and then the Sui. And okay, great. But the financial system will likely bless Ethereum. Why? Because it's been around longer. It's gone through the ups and downs. It's been battle tested. And so the probability of you being at JP Morgan saying, we're going to build on Ethereum, the probability of you being fired for that decision is low. You can obviously be fired for a number of other reasons, but making that decision makes it easy. Then the more people that make that decision, the harder it is not to make that decision. So my guess is the majority of the financial system will build on Ethereum, much like we're seeing the majority of art on Ethereum, because it just happened to be where people started doing it. Putting art, and then we've proven that Ethereum is so secure for smart contracts, the most securest platform for smart contracts, that we can only entrust our highest value smart contracts on Ethereum. Some of that will change over time, and different blockchains have their use, but so the memetic, the story we tell ourselves for Ethereum is now the financial system is moving to Ethereum. Will that be entirely true? No, but if you say it enough times, it will be true.
So Raoul's change of heart on Ethereum is simple. People copy what feels safe. If a few big players choose Ethereum, others fall in line. Safe choices become standards. That's what he means by the system blessing Ethereum. Banks and big companies feel comfortable with it because it's been around longer, it's been battle tested, the tools and legal playbooks exist, and no one gets fired for picking it. More adoption makes it safer, which pulls in even more adoption. It snowballs. There's also the Lindy effect. The longer a technology survives, the longer we expect it to keep surviving. Ethereum has lived through booms, busts, upgrades, and headlines, and it's still standing. Every extra year in the wild boosts confidence. That time advantage is a big part of why institutions trust it. And yes, there are faster chains. That's fine. Think of side streets versus the main highway. You can take quick routes for small trips, but when the cargo is heavy and important, you want the highway built for it. Ethereum is that highway. It's where the biggest, most valuable agreements get locked in. And that's why Raoul has changed his mind on Ethereum and why he's much more bullish now. The safer it feels, the more it becomes the standard. That has now happened for Ethereum, and because of it, all of the institutional money follows it. If he's right, we should see it in the money, not in opinions, in flows. Let's look. Over the last week, Ethereum ETF inflows have turned decisively positive. On October 6th, Ethereum products took in about $182 million in a single day, the sixth straight day of net inflows. Zoom out and the story holds. Cumulative net inflows into US spot ETH products are now around $15.0 billion as of October 7th, even after a choppy summer. And to add to that, Wall Street is reacting. Citigroup just raised its Ethereum price target, predicting we will see it hit $5,440, explicitly citing fund inflows and digital treasury demand, even as it trimmed its Bitcoin view on dollar strength. And it's not just ETFs. Companies are buying Ethereum like never before for their balance sheets. Bitmine immersion, led by Tom Lee, added roughly $820 million of Ethereum this week and now holds over 2.83 million Ethereum, the largest corporate ETH treasury by far. They are not alone either. Ethereum treasury companies are stacking like crazy, now holding just under 4 million Ethereum total. Here's the simple picture. Money is coming in the front door through regulated Ethereum products, while corporate treasuries are taking coins off the market at paces we've never seen before. Less available supply, more demand. That can only force prices in one direction. That's exactly the dynamic Raoul means when he says the system is blessing Ethereum. And it is in fact showing up in the numbers. Now, let's talk about what's going on under the hood. Why these institutional flows can actually reprice Ethereum violently. Unlike Bitcoin, Ethereum doesn't have a fixed supply. Right now, Ethereum supply moves based on two forces. New coins are created as rewards for people who help run the network. At the same time, a piece of every Ethereum transaction gets permanently destroyed as a fee. Think of it as new water coming into the tank and a drain letting water out. When the drain is stronger than the tap, the total amount of Ethereum goes down. That has been a powerful tailwind in the past. When the tap is stronger than the drain, supply grows. That can weigh on price unless demand is rising fast. You can see this in recent history. From October 2022 to March 2024, more ETH was being destroyed than created for long stretches. While supply was shrinking, the Ethereum price ran from about $1,100 to nearly $4,000. Roughly a 260% move. When that shrinking trend faded, Ethereum topped and pulled back. No magic, just mechanics. Where are we now? Late 2025? Well, the new coin side has leveled off. The share of Ethereum locked up earning rewards climbed from around 15% in mid-2023 to about 30% by mid-2025. Then it mostly flattened. That means the pace of new coins coming in has been fairly steady. The big change is on the usage side. Stablecoin activity keeps climbing, and a large chunk of that happens on Ethereum. More real transactions means more fees, and more fees means more Ethereum gets destroyed. In the last few weeks, transactions on Ethereum have pushed to some of the highest levels we've seen, right as rules around dollar stablecoins have gotten clearer from the Genius Act. That is exactly the kind of real-world usage that turns the drain back on. Here's the overall situation. The supply line is flattening again. If activity keeps ramping, it will likely flip back to shrinking. And when that flips, Ethereum price tends to move quickly. This is what Raoul is pointing to when he talks about the biggest, most valuable agreements living on Ethereum. As more of that value settles here, more Ethereum fees get burned and the Ethereum supply starts shrinking, putting upwards pressure on price. Now, let's talk about why the big players are choosing Ethereum in the first place. Raoul's line about not getting fired for choosing Ethereum is just how big organizations think. And this is why Ethereum is not a threat to faster chains such as Solana or Sui. Institutions want the safe choice. Ethereum has been around longer, it has been tested in bull markets and bear markets, and the rulebooks and tools already exist. Legal teams are comfortable, risk teams are comfortable, there are simple, approved ways to buy it and store it. That takes career risk off the table. Once a few credible names choose the same thing, everyone else feels safer choosing it too. That is how standards form. Banks build on it, fintechs plug into it, developers ship to it, more real activity shows up on the network. More activity means more fees means more Ethereum gets burned. New coins come in at a steady pace, but the burn starts to catch up and then pass it. The available supply shrinks while the number of buyers rises. When that happens, price responds, which brings in the next wave of institutions who do not want to be late. It is a loop. Safer choice leads to more adoption. More adoption leads to stronger fundamentals. Stronger fundamentals lead to better performance, which makes the choice feel even safer. That is why Raoul has shifted back towards a much more bullish view on Ethereum now. And it also explains why Raoul is stressing investors away from old investment ideas such as investing in real estate. Listen to how he puts it.
I've owned many properties in my life. I've had rental properties and houses I live in. They are all a sucking of costs. and time. There's always something breaking. There's always something wrong. Your tenants leave. They leave you on the lurch. They've trashed the place. You've got to redecorate it. You're not getting rent. Before you know it, you've got the mortgage payments to make. And how much money can you beat the 145% a year? Or the 100% a year? Or the 50% a year? No. So here we've got this digital property. There's only 21 million, so it's scarce. Why would you bother? You can make one investment and go to the beach and do nothing. Versus, I need to go and borrow money from the bank, hope the economic system keeps me afloat, hope I keep my job so I can pay the mortgage payments, hope the other one on the first property, I hope the other one, the payments the tenants can keep in their job, I hope, okay, great. Maybe you think you've sorted it out. Next thing that happens is everyone starts working from home and not the office. So they're leaving the city and you've suddenly got 5 apartments in a city and nobody wants to go to the city. Now what do? You can't sell them either. So you don't know. So the people who all bought office real estate, they're like, obviously companies, I just rented to them. They're brilliant. They always pay the bill. Well, everyone's working from home. Fucking real estate's empty everywhere. You still run a lot of risk, but you don't get the returns you can from investing in crypto or even investing in technology stocks. And I like the idea of crypto and technology stocks, even as holding the two and then focusing the rest of the time, just keep focusing on your income, grow your income, build your business, do what you can, because you're investing past that 2030 date. You're investing in your own demise. The acceleration of technology means technology stocks go up. The more they have to debase the currency to pay the debt for the baby boomers, the more your crypto goes up. The more that AI needs crypto to pay itself for the compute and the energy, the more your crypto goes up. Okay, so now you've got a system really working for your own disruption. So it's a hedge against your life. And then you can just focus, as opposed to finding real estate, buying real estate, doing it out, renting it out, all of the hassle. You can now focus on your job or finding another job or finding something you love that can generate more income. And then you can invest more of that income. And before you know it, you're enjoying yourself, doing something you find interesting, and the numbers are working for you.
Here's how this ties back to Ethereum. Real estate demands time, repairs, debt, tenants, and policy risk. Crypto and tech scale without the same headaches. Ethereum is the safe digital platform institutions are choosing, and the money is already showing up. As more of the financial world settles value on Ethereum, fees rise, more Ethereum gets destroyed, supply tightens, and price can reprice fast. That's Raoul's shift. Spend less energy chasing buildings, own the network the system is moving to, and focus your time on growing your income while the rails do the work. Here's the big picture. Raoul's pivot is simple. Ethereum is becoming the blessed place to lock in high-value agreements. That makes it the safe choice for institutions. The money agrees. Ethereum fund inflows have picked up into October with roughly $14.6 billion now in total net inflows since launch, and Wall Street research is turning more positive. Treasuries agree too. Bitmine Immersion just added about $821 million more Ethereum and now holds more than 2.83 million Ethereum, which is the blueprint for the corporate balance sheet era Tom Lee has been pushing. The mechanics agree, usage rises, fees rise, more Ethereum gets destroyed, and supply tightens while new issuance stays steady. When supply flips from growing to shrinking, Ethereum usually does not drift, it reprices. Bottom line. Raoul is not just talking up Ethereum. The safety logic he described is showing up in real numbers, inflows, treasuries, and rising activity on the network. If this continues into the fourth quarter and 2026, the story becomes the standard. And standards move market. And if you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in. Anyway, guys, that's all for today. Thanks for watching, and I'll see you in the next one.